Hey everyone, and welcome to this explainer. Today, we're taking a really deep dive into the massive, super capital intensive, and honestly, wildly unpredictable world of offshore drilling. We're going to peel back the curtain using hard, recent data from two absolute industry giants, Seadrill and Valaris. We're going to see exactly how they survive, how they thrive, and how they manage billions of dollars on the open ocean. Just think about an offshore drilling rig for a second. It's basically a colossal steel fortress sitting right in the middle of a totally hostile ocean. Well, it turns out the corporations that own them are built exactly the same way. They are these massive financial structures that require constant, meticulous maintenance just to survive some pretty ruthless market cycles. Because if their financial engineering fails, the whole operation literally sinks. So here is our roadmap for today. We'll be hitting 1. The offshore drilling landscape, 2. Financial health and ratios, 3. Returning capital to shareholders, 4. Executive pay and performance, 5. Governance and accountability, and finally, 6. The 2026 analyst outlook. Let's get right into it.
Starting us off with Section 1, the offshore drilling landscape.
Now, to really grasp the numbers we're about to look at, you absolutely have to respect the sheer scale of this industry. To stay competitive, companies like Seadrill can't just sit on their hands, right? They've got to constantly upgrade and future-proof their fleets through targeted, massive investments. I mean, they're managing extreme operational risks every single day. And because of that, their corporate governance, the actual rules managing the money and the people, has to be equally bulletproof. In this industry, strict capital management is quite literally a matter of corporate life and death. Moving right along to Section 2, financial health and ratios. There is a massive disconnect here that honestly trips up a lot of everyday investors. Just take a look at Seadrill's Q1 2026 results. They pulled in a whopping $358 million in revenue. But then you look at the bottom line, and they actually posted a net loss of $7 million. I mean, how on earth does a company make $1/3 billion and still lose money? Well, it all comes down to the absolutely staggering costs of capital, servicing their debt, and the heavy depreciation of those giant rigs we just talked about. And that brings us to a really crucial metric, adjusted EBITDA. Since net income can get totally dragged down by paper losses like depreciation, drilling companies use adjusted EBITDA as the real pulse check of their daily operations. It basically tells us how much cash the actual drilling activities are generating before the accountants and the bankers take their cut. And for Seadrill in Q1 2026, that pulse was a very healthy $97 million. But let's see how the market actually values that pulse. If we track Seadrill's market capitalization, it really exposes the violent cyclical volatility of this whole sector. They had a really strong 2024, then dipped down to about $2.1 billion in 2025 during some tougher times, and then a massive 115% growth rebound by May of 2026, crossing the $3.1 billion mark. This is definitely not a straight-line business. It is an absolute roller coaster. Okay, Section 3. Returning capital to shareholders. So when these companies actually manage to generate surplus cash, where exactly does it go? Well, it goes right here. $500 million. That is the sheer size of the new share repurchase program that Seadrill's board authorized to run through mid-2026. It's a massive, massive commitment to buying back their own stock. And this isn't just some random number they pulled out of thin air. It's actually born from a very strict capital allocation framework. Basically, Seadrill's stated goal is to return at least 50% of their free cash flow right back to shareholders. The board uses this exact rule to discipline their spending. It ensures that once the rigs are fully maintained and the debt is managed, retail and institutional investors alike get their rightful cut of the profits. But we need a bit of a reality check on these buybacks. Look at the stark contrast here. Back in 2024, they were super aggressive, deploying $527 million to buy back 11.6 million shares. But then you look at 2025. Zero. Literally nothing. And this perfectly illustrates how flexible these programs have to be. When they're facing a net loss year, or they just need to maintain a conservative capital structure, the board is going to slam the brakes on buybacks to protect the company's survival.
Which brings us to Section 4, executive pay and performance.
All right, let's step into the corporate command center and talk about a really crucial concept, at-risk pay. Because in modern offshore drilling, those days of massive guaranteed bonuses are heavily, heavily scrutinized. Today, the leadership only wins financially if the company's operations, the safety protocols, and, well, you, the shareholder, win first. This kind of pay structure builds a culture of extreme accountability. Just look at how a Valaris executive's bonus is weighted. Yeah, 64% depends purely on hard financials, so your adjusted EBITDA and free cash flow. But remarkably, a massive 30% is tied directly to safety and spill prevention. Think about that. If they hit their financial targets out of the park but have a severe safety failing, those executives are losing a huge chunk of their pay. Now, if you're sitting there wondering if this system actually has teeth, just compare the Valaris CEO's target pay versus what was actually paid out. In a stellar year like 2025, they overperformed and took home $9.19 million. But check out 2024. The target was $7.75 million, but the actually paid compensation swung to a negative $5.37 million because of performance metrics and stock valuations. They literally share the pain of a bad year. Let's move into Section 5, Governance and Accountability. So what are the underlying rules that keep the C-suite aligned with everyday retail investors? Valaris lays out these strict corporate guardrails really clearly. They demand robust share ownership, and they flat out forbid guaranteed salary increases. But pay close attention to the what we don't do list. Specifically, no hedging of company stock. Basically, that means an executive cannot secretly buy financial products to protect themselves if the stock price crashes. They have to face the exact same market risks as you do. And they take having skin in the game incredibly seriously. Under Valaris's mandatory ownership guidelines, the CEO is actually required to hold 6 times their base salary in company stock. Even vice presidents have to hold their entire base salary in stock. This physically binds an executive's personal wealth to the long-term survival and success of the rig fleet. And if they aren't compliant, they are strictly barred from selling their equity. Finally, Section 6, the 2026 Analyst Outlook. Bringing all of this up to the present day, a really clear chronological narrative emerges. Seadrill and Valaris have been just ruthlessly disciplined. From Seadrill's initial buybacks in 2023 to Valaris proving their model by recording over $340 million in free cash flow at the end of 2025, the market has definitely taken notice. By May of 2026, we're seeing analysts giving Seadrill strong buy upgrades as the stock pushes past $50. Good governance and strict capital allocation are driving some very real momentum right now. Which leaves us with this final thought. You've seen the true anatomy of these massive corporations now. You've seen how surprisingly easy it is to generate hundreds of millions in revenue, but still post a net loss if the capital isn't managed absolutely perfectly. So as you go out and do your own research, you really have to ask yourself, what matters more to you? The massive scale of a company's revenue or the strictness of the corporate governance actually holding the checkbook? Thank you so much for joining me on this explainer. Keep learning, keep questioning, and I'll catch you next time.